Hello everyone, once again welcome back to Global Online. So if you are preparing for the upcoming December attempt of NTA UGC NET examination, especially if you are preparing from the commerce or management paper 2, accounting and auditing subject is very important, and this is common subject for both the subjects, okay, whether you are preparing from commerce or management. So in this session we will be discussing 20 plus most expected MCQs on capital budgeting, which is very important topic of accounting and auditing, in which we will be discussing how to calculate it and what kind of questions can be asked in the examination, or maybe these kind of questions directly or indirectly can be asked in the exam, right? So I suggest in each and every student, please watch this video till the end and share as maximum as you can.
But before starting the session, very important thing I would like to share with you all. If you are seriously preparing for the upcoming NT UGC NET examination, which is December attempt 2025, we have come up with the paper 2 complete course for management and commerce people. In this course, you will be guided by the experts to increase your score in the examination and qualify this examination. In this course, you will get complete video lectures, which will cover your all the units. Complete syllabus notes will be provided. Mock test will be provided to you, so you will practice more and more and your confidence will be building up, right? PYQs with explanation, doubt clearing sessions, marathons, these all things, all materials will be provided to you. Okay, so if you want to join this course, just contact on this number. You can do WhatsApp message or WhatsApp call and join this course. Okay, or else you can also go to the Play Store, download the application, that is Global Online. Okay, search Global Online on the Play Store. You will see this logo on that application. Download that application and you can join the course. Okay, all right, so this is first question you can see on your screen. Which of the following is not a capital budgeting techniques? So there are different kind of capital budgeting techniques. So in the options, there is a one option which is not included in the capital budgeting technique. Okay, so which of it? Payback period, NPV, IRR, or debt equity ratio? Okay, so it is straight and clear that option D is the correct answer, because debt equity ratio is not the technique for capital budgeting. Okay, debt equity ratio is there in the financial ratios that we have discussed, how to solve the debt equity ratio. Okay, so this is not the thing. See, debt equity ratio is the capital structure or leverage ratio, not capital budgeting technique. Correct. So capital budgeting tools evaluate investment viability like NPV, IRR, payback, PI. These are the techniques to solve the capital budgeting techniques. Oh, sorry, capital budgeting questions. Clear? So these all will be, we will be discussing. Clear? Next is, this question is on the payback period. This is the one of the technique of capital budgeting, right? So question is, the payback method primarily ignores which factor? Initial investment, cash inflows, time value of money, or liquidity. So what is it? It is time value of money. See, payback method is the only considers how quickly the investment is recovered, right? So payback method will give you the idea the how much time it will take to pay the remaining things, right? So it will give you the clear idea how quickly the investment is recovered. Okay, it ignores the timing value of money and cash flows beyond the payback point. Clear? Next, which of the following uses the discount rate that makes NPV is equal to 0? Accounting rate of return, payback period, internal rate of return, or profitability index. Okay, so it is internal rate of return, which we called IRR in short term. Correct. See, IRR is the discount rate where total PV inflows is equal to total PV outflows, right? That is why NPV will be is equal to 0. Next question. So this kind of questions that we are discussing, like this question is asking about the PI formula. Okay, so it will be giving you the formula also, and on that kind of thing they can ask different questions, right? They may give you a partially formula and a remaining part will be the blank, right? So they can ask which of the following is the correct option, which is fulfilling the correct formula. Correct? Getting it what I'm trying to say? So option A, PV of cash inflows divided by PV of cash outflows. B, cash inflows divided by cash outflows. C, NPV divided by cash outflows. And D, cash inflows minus cash outflows. So right answer is option A, that is PV of cash inflows divided by cash outflows. Okay. This is the formula, PV inflows divided by PV outflows. If PI is greater than 1, it is accept project. Okay, it is accepted. Next question, if the initial investment is rupees 1 lakh and the PV of cash inflows is 1,40,000, the PI will be what? Okay, so just we have discussed the formula of PI. What is it? PI, sorry, PV inflows divided by PV outflows. Okay, so investment is 1 lakh and the PV of cash inflows is 1,40,000. So investment, that means outflow, right? Our cash flow is getting out, getting it? That is why we have invested. So 1 lakh and 1,40,000. So inflows, right, divided by outflows, right? What will be the answer? Here also 1.40. Answer should be 1.40. Option B. Right, option B will be the correct answer. Here you can see, so PV inflows divided by PV outflows, 1,40,000 divided by 1 lakh, option will right answer will be 1.40. Which technique is considered superior as it considers both time value of money and cash flow after payback? Okay, A, payback period, B, NPV, C, ARR, and D, payback reciprocal. So option B, NPV will be the correct. NPV is theoretically the best method as it considers both the time value and all cash flows. Okay. If IRR is greater than the cost of capital, then the project is rejected, accepted, kept in abeyance, or indifference. So just we have discussed, right? It is accepted. IRR is greater than cost of capital, then it will be accepted. This project will be accepted. Okay, when IRR is greater than cost of capital, the project generates more than required return. Okay, that will be accepted. Which of the following is not discounted technique, non-discounted technique? Payback period, NPV, IRR, or PI? It is payback period. It is a non-discounted technique. Okay, payback and ARR are non-discounted methods. They don't consider time value of money. Which of the following is also known as average rate of return, which is ARR? IRR, ARR, that means accounting rate of return, NPV, and payback reciprocal. So it is accounting rate of return. Which of the following is also known as average rate of return? It is accounting rate of return. Okay, ARR, average annual accounting profit divided by average investment. So we will have ARR. Okay, if the NPV, in the NPV technique, a project is accepted if NPV is greater than 0, sorry, is less than 0, NPV is equal to 0, NPV is greater than or equal to 0, or NPV is less than or equal to 0. So right answer is option C. NPV is greater than or is equal to 0. Okay, NPV, net, sorry, present value of inflows minus present value of outflows. Okay, if NPV is greater than or is equal to 0, the project adds wealth and is acceptable. Okay, remember these formulas and how it is calculated and what will be the result of it. Okay, which of the following techniques is also called the discounted cash flow, DCF technique? Payback period, net present value, accounting rate of return, or payback reciprocal. So the right answer is option B, net present value. It is also called the DCF, that is discounted cash flow technique. Okay, see, DCF technique, discounted future cash flows at cost of capital. Remember this. Okay, DCF techniques discount future cash flows at the cost of capital.
and NPV is the most popular DCF technique. Getting it? So basically NPV is included in the DCF techniques. Okay, it is a part of that. And payback and ARR are not discounted techniques, which is not considered in the DCF techniques basically. So NPV is the kind of a DCF techniques, that is why it is considered as a DCF. Understanding? Next, this is the calculative question. An investment requires 40,000 rupees. It generates cash inflows of 10,000, 12,000, 14,000, and 15,000 respectively. Correct. In the 4 years. Find the payback period. Okay. In the previous session, we have discussed the formula of payback period. Okay. How to calculate these kind of questions. Now I'll explain you how to solve these questions. Okay. First, the right answer is option is 3 years. Option B 3 years. Now, first thing, remember how much we need, how much we require. 40,000, correct? 40,000 we require. That means the investment we require, right? Investment, that means it is the outflow. Getting it? And in the question, they have given the inflow, correct? 4-year inflow, and we need 40,000 only for investment. Now, first year, okay, the inflow was 10,000. Cumulative, if we consider, it will be 10,000 only because this is the first one. Then second year it is 12,000. So we can add in the 10,000. It will become the cumulative 22,000. Then third year, okay, inflow was added 14,000. So we will add it in a 22,000. It will become 36,000, right? And then in the fourth year, 15,000 inflow was there, and cumulatively it is 51,000. Correct. But in the third year, it is 36,000 only. It is 36,000 only. That means what, how much we need extra? We need 4,000 extra. Correct. Here I have calculated recover fully in 3 years. It should be recovered in a 3 years, right? So 36,000 was inflow and we needed 40,000 for the investment, right? So 4,000 we needed extra. So the 40,000 minus 36,000, we need 4,000 extra, right? But in the fourth year, 15,000 inflow was added, right? So it is covered 4,000. 4,000 was covered in the fourth year, correct? So 4,000, okay, divided by 15,000, we have 0.27 year. What is it? 0.27 year, correct? So total payback is 3 plus 0.27, that means 3.27 years. Okay, payback period will be 3.27 years. So basically we consider it 3 years. Okay, so right answer was 3 years. Next question. The reinvestment assumption in IRR method is that intermediate cash inflows are reinvested at cost of capital, IRR, risk-free rate, or market rate. It is the IRR. Okay. NPV assumes reinvestment at a cost of capital, whereas IRR assumes reinvestment at IRR itself. Okay, remember this point. Next, a project cost 50,000 and generates annual cash inflows of 15,000. Okay, project cost is 50,000 and annually the inflow from that project is 15,000. Okay, for 5 years. The discount rate is 10%. Okay, and use PV factor of 10% for 5 years, 3.791. Find the NPV. Okay, so NPV will be 6,865. How? So PV of inflow 15,000 per year we have. Okay, 3.791 it is totally calculated and they have given in the question itself. So right answer will be PV of inflow will be 56,865, right? So NPV, now we need to calculate NPV. So NPV is equal to 56,865, that is your PV of inflow, minus 50,000. What is it? Project cost, correct? So what will be the answer? 6,865, right? So as per this, decision will be, it will be accepted since NPV is greater than the 0. Okay, NPV is greater than the project cost, right? So it will be accepted. Next, which of the following methods gives multiple results when cash flows are unconventional like sign changes. Okay, NPV, IRR, ARR, or payback. Right answer is IRR. If cash flows alternate between positive and negative more than once, IRR can give multiple solutions while NPV gives unique value. Okay. Project requires 1,20,000, PV of inflow 1,50,000. Find the profitability index, right? So right answer will be 1.25. How it is? PI is equal to PV inflows divided by PV outflows. Correct? So 1,50,000 we have inflow and 1,20,000 we have outflow. So right answer will be 1.25. It is as simple as. Okay. Which method is appropriate for ranking mutually exclusive projects? Payback, ARR, IRR, NPV. Right answer is NPV. Mutually exclusive, one only project can be chosen. NPV is the best as a measures absolute wealth addition. So that is why the right answer was that. A project requires 2 lakh, expected annual accounting profit 40,000, average investment 1 lakh. Find ARR. Okay, so 20% will be the answer. How? ARR formula we need to understand first. What is formula of that ARR? Average annual profit divided by average investment into 100. Okay, 40,000 given, 2 lakh is given into 100, 20% will be the right answer. Okay, it is really very easy, but only when you remember the formula. Next, a project cost 1 lakh. It generates annual inflow 25,000 for 5 years. Find approximate IRR. Okay, PV factor 10%. Okay, for 5 years that is calculated. PV factor at 15% for 5 years is 3.352. Okay, right answer will be 14%. See here, at 10% PV is 25,000. Okay, into 3.791, it will be 94,775. Okay, at 15% PV is 25,000 into 3.352 is equal to 83,800. Okay, cost is greater, but still it is less than 10%. Getting it? Interpolation will be IRR 10% plus 94,775 minus 1 lakh divided by 94,775 minus 83,800. Okay, into 15% minus 10%. Okay, then 10% plus this is calculated. Okay, the 15 minus 10, then 5% will be remaining. 10% minus 2.38%. So right answer will be 12%. Right, so it should be more than 12%. Okay, it is more than 12%. Correct. Actually it is 12.38%. So it is more than 12%. So it should come under the 12 to 13. Correct, 12 to 13 range or 12 to 13 category. Correct, but there was no option like a 13 or 12.38. Right, 12 was there, but it is not exactly 12. It was 12.38. That means just little bit more than 12%. So it should come under the 12 to 13 or uske aspas, right? So 14 was there in the option, so 14 will be the correct answer. Okay, sometimes ऐसे भी होता है, राइट, एग्जैक्टली पॉइंट वाइज आंसर तो नहीं रहेगा ऑप्शन में, बट यू हैव टू करेक्ट द ऑप्शन विच इज नियरली okay correct answer. So 14 will be the correct answer. All right, so this is all about today's session, everyone. I hope you all are understood what questions are asking in the examination and how to calculate these kind of questions. Okay, if you not understood anything, please comment in the comment box. Okay, I'll take some of the new questions on the similar topic and it will be beneficial for you. Right, so thank you so much. Have a great day. See you in the next session.